Welcome to Breaking News to Trading Moves.
Today, we are looking at something you sent over that has really captured the market's attention.
It really has. We're zeroing in on the anticipation around a single company's financial report.
That's right. The next earnings release from Nvidia, ticker NVDA.
Exactly. And the material we're looking at makes it clear this isn't just about one company's balance sheet. The market is treating this event as a kind of vote.
A vote on the health of the entire AI boom.
That's the thesis. This single report is being viewed as a decision point for whether the AI rally continues or if it takes a pause.
So we need to lay out what's on the line here, because the material frames the outcomes in very stark terms.
Two distinct paths.
Two very distinct paths with very different outcomes for, well, almost the entire tech market. Path one is the bull case. A strong beat on their numbers combined with really confident guidance for the future.
And path two.
The bear case. A miss, or maybe even more importantly, a cautious outlook. Any hint that demand might be moderating.
So our mission today is to trace those paths. Based on the material, we're going to explore which specific companies and which sectors are positioned as potential winners if that bull case plays out.
And conversely, which ones are classified as the potential losers if we see that more cautious scenario unfold. We're following the expected effects from direct suppliers all the way out to the more speculative software companies.
Okay, let's start with the foundational question, though. Why has Nvidia NVDA been elevated to this status? Why is it the sole proxy for the AI trade?
Well, it really comes down to their position in the ecosystem. The material is very clear on this. They are at the absolute nexus of the AI hardware stack.
It's more than just being a big player.
Oh, it's more than that. Their position is structurally dominant. They have what is often described as a near monopoly on the high-end hardware.
The GPUs.
The graphics processing units, exactly. These are the specialized engines that you absolutely need for developing, training, and deploying large language models, LLMs.
So they're the bottleneck, or the accelerator, depending on how you look at it.
That's a great way to put it. When any single company acts as that essential choke point for a massive technological movement, its financial performance automatically becomes the pace clock for the entire sector.
And the market's expectations, as we can see, have become very binary.
Extremely binary. On one side, if Nvidia delivers a strong report, it's taken as confirmation of sustained, maybe even accelerating growth in demand for AI infrastructure.
It validates all the spending we've seen.
It validates all of it. It confirms that the huge capital expenditures, the CapEx we've seen over the last year, are not just continuing, but maybe even growing faster than people thought.
And that spending it's at a level we haven't seen before.
It's completely unprecedented. Trillions are being directed towards building out this infrastructure. So if the report is weak, or if the guidance points to even a slight slowdown,
then the whole narrative gets questioned.
Immediately. The concern just floods the market. If the supplier of the most critical component says orders are cooling, traders instantly question the velocity of the whole transition.
And it's not just about the physical chips, is it? The software ecosystem plays a massive role here, too.
It absolutely does. You can't separate the two. The power of NVIDIA's GPUs is matched, maybe even surpassed, by the strength of its CUDA software platform.
CUDA?
Right. It's the parallel computing architecture that developers have been using and standardizing on for more than a decade now.
So there's a lock-in effect.
A huge lock-in effect. It means even if a competitor makes a chip with similar raw horsepower, it doesn't have that vast established ecosystem of tools, libraries, and trained engineers that CUDA offers.
So developers are just used to it. They're trained on it.
They're trained on it. The code is written for it. That software dependency reinforces NVIDIA's central position. It makes their report even more definitive for the health of the AI industry in the short to medium term.
Okay, so let's really focus on those two scenarios you laid out, because they seem to dictate every reaction down the line.
Let's start with scenario A, strong performance and confident guidance.
The bull case.
The bull case. This tells the market that the core demand engine, the need to build and scale AI models, is running at full throttle. This outcome would be expected to reignite the AI rally.
Pushing everything up with it.
Everything related to it. It would push momentum across all related sectors and validate the high valuations that we see across the entire ecosystem, from the hardware all the way to the software. It confirms the thesis that demand is still outstripping supply.
Which keeps prices on munitions high for Nvidia.
Precisely.
Now, what about the other side of the coin? The riskier scenario.
Scenario B, a miss or a cautious outlook. Now, if Nvidia comes in short of expectations, or and this is the key part, if they project a slowdown in data center spending.
Which is their main business now.
It's their bread and butter.
Mm.
The consequences are immediate and they are broad. This outcome would affect everyone. Competing chip makers, the big cloud names who are the biggest spenders, and of course the highly speculative AI stocks.
The ones that really need the story to remain perfect.
Exactly. Traders would be forced to de-risk. They have to adjust their growth projections for AI as a whole, and they do it very, very quickly.
That framework is very clear. So let's walk down the first path. Let's assume scenario A plays out. The market gets the strong report it wants to see. Who stands to gain the most right away?
Okay, so the report is strong, the guidance is confident. The immediate reaction is going to favor the companies that are most tightly woven into that AI infrastructure build-out.
So we're starting with category 1, the AI chip leaders and suppliers.
The most direct beneficiaries. You have to start with the companies providing the foundational tech. That's Nvidia, NVDA itself, and its key hardware partners, like Broadcom, ticker AVGO.
So for Nvidia, a strong report isn't just about looking back at a good quarter. It's about confirming the future.
It's entirely about the future. It's about validating that premium valuation. It projects their future supply capability against what appears to be insatiable current demand.
And if they beat expectations, especially on the data center side,
It just reinforces their status as the essential provider. It validates the billions they've poured into new architectures like their Blackwell platform. It shows they can maintain pricing power and keep those high gross margins.
it also confirms that the big cloud companies are dedicating their budgets to Nvidia's latest, most expensive gear.
Yes, that the CapEx from the hyperscalers is flowing directly to them. Now let's talk about Broadcom, AVGO.
Why are they considered a core, immediate winner here? They're a supplier, but this seems more direct.
They are classified as a core winner because they're not just a supplier. They're an integral co-architect of the modern AI data center. While NVIDIA makes the GPU, Broadcom provides specialized components that are absolutely essential to make thousands of those GPUs work together.
So they're not just off-the-shelf parts.
No, not at all. They designed custom silicon, what we call application-specific integrated circuits, or ASICs. They do this for networking and for custom interconnects. This is highly specialized.
So their benefit is tied to the growing complexity of these AI data centers.
Precisely that. As NVIDIA packs more and more GPUs into a server rack, the networking speed required to transfer data between them has to scale up right alongside it
To avoid bottlenecks.
to avoid the whole system grinding to a halt. Broadcom is a leader in things like 800 gig Ethernet and specialized switching fabric that allow these massive AI supercomputers to function. So if NVIDIA's numbers are strong, it directly implies that the whole ecosystem of accompanying hardware is also seeing robust demand.
Especially the high-end, complex stuff that Broadcom sells.
Exactly. It confirms spending is going into those high-end deployments, which is a direct benefit to Broadcom's most specialized and most profitable product lines.
Okay, let's get even more granular. Let's drill down into the supply chain and talk about Micron Technology, MU. The material points out that their potential benefit hinges on a very specific piece of information in NVIDIA's report.
Yes, this part requires a bit of detailed attention. Micron is a leader in something called high bandwidth memory, or HBM.
And HBM is not the same as the regular memory in my laptop.
Not even close. It's radically different. HBM is specialized, vertically stacked memory that has to be physically integrated, packaged right next to the GPU itself.
Why is that necessary?
It's all about data throughput. Massive AI models, especially during the training phase, need to be fed data at extreme speeds. Standard memory, DRAM, just can't move data fast enough. HBM is the solution.
So how does a strong NVIDIA report translate into a win for Micron MU?
It translates to the commentary around HBM demand. In their reports, NVIDIA often gives some insight into their supply chain and any constraints they're facing.
So the market is listening for specific keywords?
They are. If NVIDIA mentions that the adoption rate of their HBM-equipped chips is soaring, or even better, if they say HBM supply is a limiting factor for them,
That's a powerful signal for Micron.
a very powerful validation. It signals strong, non-commodity demand that supports higher pricing and higher volume for this specialist AI memory, which directly boosts Micron's profitability. HBM is a premium, high-margin product.
So confirmation that the industry is moving quickly towards these more expensive chips is a strong tailwind for Micron's business.
It is. And it makes that specific detail, that one piece of commentary, potentially more impactful for Micron stock than the general headline sales figures from NVIDIA.
It's amazing how granular the analysis gets. The market isn't just listening for a number, it's listening for clues about component constraints and the adoption of advanced technology.
Okay, let's move up the value chain a bit. If NVIDIA's data center revenue is soaring, that gives us a direct window into the spending habits of their biggest customers,
The cloud providers.
the largest cloud providers. This is what the material refers to as the hyperscaler confirmation.
We're talking about companies like Microsoft and Amazon. They're some of the biggest buyers of NVIDIA's hardware on the planet.
They are. So if that infrastructure spending is still going strong, it confirms the long-term investment thesis for companies like Microsoft, MSFT, and Amazon AMZN.
Let's take Microsoft first. Their cloud platform is Azure. What does an NVIDIA beat specifically validate for their strategy?
Microsoft is massively integrating NVIDIA's GPUs into Azure. They use them for their own products like Copilot, and they sell access to that power to their commercial clients.
So a strong NVIDIA report means demand from these clients is heavy and it's sustained.
It validates their huge capital commitment. It confirms that pouring capital into AI infrastructure to power Azure AI services is the right move. It supports their long-term growth story and suggests that high utilization rates are following that big investment.
But I have to ask, isn't there a counterpoint here? Does spending so much on NVIDIA's chips also highlight a risk? That they're too reliant on a single supplier?
That is an absolutely crucial point, and the material does bring it up. While high sales confirm Microsoft's current strategy is working, it absolutely raises that long-term question of concentration risk.
If NVIDIA is too dominant.
If they're too dominant, these hyperscalers feel enormous pressure to develop their own custom silicon. We see this with Microsoft's Maya AI accelerator or Amazon's Trainium and Inferentia chips.
So they're trying to build an alternative.
They are. But, and this is the key for the near term, a strong NVIDIA report confirms that despite those internal efforts, the immediate overwhelming need for top-tier performance is forcing them to keep buying NVIDIA chips in massive volumes. It validates the current spending cycle, even as it hints at future competition.
And the logic for Amazon, AMZN, and their AWS platform follows a similar line of thinking.
It mirrors it very closely. Amazon Web Services, AWS, is also in a race to build out its AI and machine learning infrastructure. And NVIDIA Beat validates their own high CapEx cycle.
It tells the market that the investment is a multi-year priority.
That's right. It's designed to ensure AWS remains competitive against Azure and Google Cloud. The confirmation is that, regardless of their own chip development, the demand for cutting-edge performance dictates an ongoing aggressive purchasing schedule of NVIDIA's best products.
Okay, so that brings us to the next category, AI servers and networking. This is the physical deployment layer.
This is where the rubber meets the road. The companies that build the actual infrastructure that houses, powers, and connects all of these powerful chips.
You sell all the chips you want, but they need a specialized home.
And strong GPU sales are meaningless without those specialized environments.
So we have to talk about Supermicrocomputer, SMCI. This company has had just an extraordinary run because of its position as a go-to supplier for AI server systems.
An optimistic update from NVIDIA on GPU shipments and new architectures gives a very strong lift to Supermicro SMCI. Their whole business is designing and manufacturing these AI-optimized servers and rack-scale solutions.
And what makes them so special? What's the technical advantage?
They are experts at dealing with the extremely high power and thermal management requirements of modern GPU clusters. A traditional server just can't handle it.
Can you elaborate on that? What are the specific problems they're solving that makes them such a clear winner here?
Sure. Traditional servers are not designed for the dense power draw of chips like NVIDIA's Hopper or their new Blackwell platform. SMCI's expertise is in two main areas: specialized power delivery systems and advanced cooling.
And we're not just talking about bigger fans.
No, we're increasingly talking about direct liquid cooling, or DLC, solutions. The newest NVIDIA chips are so power-intensive that standard air cooling just isn't enough anymore.
So if NVIDIA is selling a lot of their next-gen high-powered chips,
It means that data centers must adopt these sophisticated cooling solutions. And SMCI is positioned as a leading provider of these specialized high-margin server racks. That tight technical coupling makes them a very clear beneficiary of a strong NVIDIA report.
Okay, finally in this section, we get to the connectivity layer with Arista Networks, ANET. Networking can sometimes get overlooked, but the material stresses how central it is in these AI data centers.
It's not just a utility anymore. For AI training, the network is a core performance constraint.
And Arista, ANET, they supply the specialized switches.
Exactly. The high-performance, ultra-low latency switches that you need to link thousands of individual GPUs together into one cohesive, functional supercomputer.
It's all about latency, the delay in communication between the chips.
It has to be minimized for training these large language models effectively.
So why does a great NVIDIA report translate into an immediate gain for Arista networks?
Because increased GPU sales translate directly into demand for better network infrastructure. AI workloads require this massively parallel computing, which in turn requires high-speed, non-blocking interconnects.
Which is Arista's specialty.
It's what they do. They specialize in the high-speed Ethernet technology that can handle this. So if the number of GPUs being shipped goes up dramatically, the demand for Arista's specific type of high-speed switch goes up right alongside it. They're the plumbing system for the entire NVIDIA hardware complex.
So to sum up the winners then, a positive NVIDIA report validates this entire ecosystem. It starts with silicon makers like Broadcom, AVGO, and specialized memory from Micron, MU.
Then it confirms the massive spending strategies of the cloud giants, Microsoft, MSFT, and Amazon, AMZN.
And finally, it pulls up the physical infrastructure suppliers like Supermicro, SMCI, and Arista Networks, ANET.
That's right. Now we have to turn our attention to the other path, scenario B.
The cautionary outlook.
Yes. If NVIDIA disappoints, or even if they just signal some caution about future AI spending, investors will immediately start to question the overall pace of growth.
And that nervousness leads to de-risking.
Rapid de-risking. And potential sell-offs, especially in companies whose valuations rely on gaining market share or maintaining these really explosive growth rates.
So let's start with the first category of potential losers, the direct GPU rivals.
And it's important to frame this correctly. Even if the overall AI market is still growing, an overwhelmingly successful report from NVIDIA can still be a negative for its direct rivals.
We're talking about advanced micro devices, AMD and Intel, INTC.
Right, and it's all about relative performance. If NVIDIA delivers a quarter that just blows past already high expectations, and this is critical, confirms that its next-gen chips are widening their performance lead.
Then AMD and Intel often get marked down immediately.
They do.
So why does NVIDIA's success become a specific vulnerability for AMD in this scenario?
AMD is trying very aggressively to compete in this high-end AI accelerator market with their MI series of chips. But a blowout performance from NVIDIA just strengthens the market's conviction that NVIDIA's position at the high end is, for now, unassailable.
It suggests the big customers are sticking with what they know.
It suggests that the hyperscalers are prioritizing the proven stability, the performance, and, crucially, that mature CUDA software ecosystem over any potential cost savings or performance claims from AMD's newer platform.
So it's not just about the speed of the chip, it's the entire development environment around it.
It's absolutely about the entire environment. The cost and the difficulty of switching away from the NVIDIA and CUDA ecosystem, that vendor lock-in, is immense.
So a great NVIDIA print just undermines the competitive story for AMD.
It does, because it reinforces the idea that the amount of business AMD needs to win to justify its valuation just isn't materializing fast enough. Market share momentum is everything, and a dominant NVIDIA report suggests that the window for AMD to really break through is either shrinking or just being pushed further out.
And what about Intel, INTC? They're also chasing this market with their own chips.
For Intel, the challenge is even greater. They have very ambitious plans for their own AI chips and the future of the data center. But a strong NVIDIA report implies that the performance standards and the barriers to entry are just continuously getting higher.
The goalposts keep moving.
The goalposts keep moving further away. If NVIDIA keeps pulling ahead, it just makes the path for Intel to gain any meaningful traction in high-end AI that much steeper and more expensive.
And the investment community reacts to that.
They have to. They have to adjust their projections for how successful Intel can be in this premium segment, and that often leads to a lower valuation as traders consolidate their bets behind the clear leader.
So the story becomes one of a winner-take-most market, which squeezes the competitors, even if the total market is getting bigger.
Precisely. They're seen as relative losers because their potential for market share gains is being postponed by NVIDIA's ongoing dominance.
Okay, let's move away from the hardware battles. The next category of potential losers is the high multiple AI software names.
Yes, now we're in the world of software companies that have achieved extremely high valuations based almost entirely on the expectation of rapid, widespread AI adoption.
And if confidence in the underlying spending slows, these are the names that are immediately vulnerable.
The core risk here is purely about valuation. These companies are priced for exponential future growth, not for their current profitability.
So if Nvidia disappoints or just guides cautiously,
It casts this shadow of doubt. It makes the market question the speed and the willingness of corporations to adopt AI at the pace that was promised. If the hardware foundation is slowing down, the logic is that the deployment of software on top of it must also slow down.
let's talk about a specific example, Palantir, PLTR. Their business model is built on getting large government and corporate clients to adopt their advanced data platform.
Palantir has a very high valuation that is predicated on their ability to quickly and profitably monetize their AI platform, AIP.
So if the overall spending outlook softens because of Nvidia's caution,
Investors will immediately question how fast Palantir can close those large, expensive commercial contracts. It calls into question their ability to scale their recurring revenue.
because their growth is fueled by their clients making aggressive investments in AI.
Exactly. Any hesitation in the hardware layer is going to translate to hesitation in the software layer. That makes high multiple names like Palantir candidates for sharp selling as traders just look to reduce exposure to these riskier growth stories.
And the material mentions Snowflake, SNOW, as facing a similar kind of exposure, even though they have a different business. They're a data cloud.
Snowflake is highly sensitive to this sentiment because their valuation is built on a consumption-based model. Their clients pay based on how much data they process and analyze.
So they need their customers to be doing more and more with their data.
And a lot of that more is supposed to come from AI. Their platform is essential for companies building and running AI models. But if the enterprise rollout of AI is slower than anticipated, as implied by a cautious NVIDIA report, then the consumption of their services for AI workloads might fall short of the market's aggressive expectations.
So any question about the speed of AI adoption directly justifies traders exiting these high multiple stocks.
It does. They'll seek out companies with more predictable, less future-dependent revenue streams. These are companies that suffer not because they did anything wrong, but because the foundational assumption that AI growth is immediate and unstoppable has been challenged.
That brings us to our final category of potential losers, the speculative AI and quantum plays.
This is the furthest end of the risk spectrum. We're talking about the highly speculative companies. These are often story stocks.
Their value is based on a long-term vision, not current profits.
And the material really stresses that these are the companies that see the most extreme swings when sector sentiment pulls back. They are the high beta stocks that are running purely on future optimism.
It's a dynamic we see often.
It is. These speculative companies are the first to be abandoned when a generalized risk-off sentiment takes hold. They're basically trading on the dream of advanced computing technologies years and years down the road.
The specific examples mentioned are IonQ, IONQ, and Rigetti Computing, RGPI. These are names associated with quantum computing.
Right, and companies like these, especially in quantum, are extremely sensitive to shifts in overall AI sentiment because their current revenue is minimal, if it exists at all. Their market cap is a long-dated, high-risk bet on a revolutionary future.
So if a weak NVIDIA report triggers a general fear that the commercial AI boom is faltering,
Investors lose their tolerance for these very long-term, high-risk bets. They just don't have the patience for companies that lack any near-term path to profitability.
it's a psychological link then, driven by traders looking for safety.
It is absolutely psychological. A weak NVIDIA report causes a broad move out of speculative high-beta assets. The money flees from the periphery of the AI trade first. It seeks safety in established, profitable parts of the market.
So stocks like IonQ and Rigetti Computing can see these steep drops.
Not because NVIDIA's chip sales have any direct effect on quantum research tomorrow, but because they are the furthest removed from guaranteed revenue. That makes them the easiest and fastest assets to sell during a period of nervousness about AI's immediate future. The correlation is driven by market psychology and capital preservation, not by any direct supply chain link.
So we've meticulously walked through the core reliance explored in the material, the market's dependence on this one earnings report from Nvidia, NVDA, as the definitive measure of AI spending.
And we've seen how the outcome of that report is positioned to influence companies all across the tech landscape.
It can confirm the investment thesis for a specialized hardware supplier like Supermicrocomputer, SMCI, or can undermine the valuation of a high-growth software name like Palantir, PLTR.
What becomes really apparent from analyzing all of this is the sheer concentration of the market's focus. The fact that one company's financial performance is treated as a definitive vote on the destiny of an entire multi-trillion-dollar technological movement.
The AI boom.
The AI boom. It really underscores the market's current fixation on concentration. This singular reliance, it raises some real questions about the industry's risk profile versus the need for diversification in this infrastructure build-out phase.
A final thought for you, the listener.
Yes. You should consider what this centralized power means for the pace of innovation and for competition as we move forward.
We must close with our mandatory statement.
This discussion has been based purely on the analysis of provided material and should not be construed as financial advice or buy or sell recommendations regarding any stock or security mentioned. This is purely the opinion of the author.
Thank you for joining us for Breaking News to Trading Moves.
We appreciate your attention and look forward to our next discussion.